Combination of things, because you have not had a earning growth in the corporate sector for last 5-6 years. So that is one clear thing. Second, there was developed markets were doing so well that you have US market itself delivering and so many good companies. So why will people want to take risk in the emerging markets? And on top of that, all this, as you rightly said, all this negative rumors and noises. Someone sitting in America only hears all these rumors. Obviously, they are scared. A combination of lot of factors which are generic to emerging market. So I don't think the FIs was a case like they did not want to invest specifically in India. It was like we are part of the global basket, plus few other reasons which were more specific to India. Okay. But now we've seen some change in the last 5-7 days. At least those flows are coming back.
They have been coming in. It's slow, but it has. They're coming back. Tell me, at this point, is sitting down and analyzing your portfolio the right approach? Trying to take riskier bets, but obviously, from a business standpoint, with the corporate tax cuts that have been announced, the business environment can start taking a little more risk to accelerate growth. But from a stock market standpoint, when does that risk appetite truly come back?
So, Devina, there are a few points here. One, I don't think you need to be extraordinarily adventurous to make money in the markets today. Because as I told you, in the mid-bracket, there are so many good companies which are available, which are small, mid-cap, even some large-cap companies are available, which are available at reasonable valuation because of the perception issues which are there, Just again an example, I'm not recommending anything. Look at something like State Bank of India. Now it's only a perception issue that how can State Bank trade at 0.6, 0.7 time book value given whatever is happening. But the perception is that there is a lot more write-offs which is there in the pipeline, and lot has happened, but a lot more is there. Now what can you do to that? So I am just saying that is one issue which is there. So you don't need to take any real extraordinary risk, or you don't need to be extra brave to find good returns in the market. So that's point number one. Point number two is that when you identify a company, because of this regulation change which happened, which came from the regulator, that mutual fund fundamentally this much percentage you can invest in small cap, large cap, mid cap companies, and that bifurcation has happened. So many of the small cap companies, specifically which are like below 7,000-8,000 crore rupees of market cap, has completely more or less being left out from the investing universe. This is a very, very important point. And because
large participants are missing out on that.
And the market itself is got beaten down, and then whatever market which was there for these companies has also been taken away. I am very sure at some point of time the regulator will review the list itself, the fundamental, because if the market as a whole has collapsed, that 8,000 crore should not be a static number. So a lot of good companies are left out basically.
But the retail participant, obviously, it's the more popular stocks that come into the eye of the retail participant as well.
Retail participant has anyway got smashed because of what I explained to you. We were looking at the top 1,000 companies. There are 50% of the companies have lost more than 50% of the market cap. Like 550 companies have lost more than 50% market cap. And there's obviously the retail ownership in all these companies was very, very high. So obviously retail public will only come when there is a confidence that your earnings will start to look up. There will be some level of buoyancy which will be felt in the market. And now the retail public anyway, whoever is a committed investor is coming through mutual fund. The fact that you are still getting more than 10,000.
Your SIPs are going on a regular basis.
Money, I think people are investing regularly through mutual fund. In turn, those mutual funds are not investing in these companies. So that is a gap.
Do you feel that, from a retail investor standpoint, the portfolio, which is, say, for example, divided between large caps and mid caps, by the pure function of the fact that these large caps have overshot the mid caps and the mid caps have underperformed, the inherent weightage of those large caps in the portfolio has gone up, but they're still ready to buy more large caps than mid caps and take risk on.
See, I ran money for such a long period of time. So this is like a hiding time. Whatever works is what most fund manager will like to do. You don't want to be adventurous, and people who have been adventurous in the last 2 years have burned their fingers badly. And plus, all large companies have benefited disproportionately because of this tax rate cut. So if they were available at, let's say, 10 P multiple because of the tax cut itself, suddenly the P multiple has fallen by 20%.
So it's given you that much more headroom to go.
Exactly.
To cover
so to that extent, it has given you much more headroom. Even if you are at the same valuation, a stock price justification of more than 25% from where it was before the tax cut is justifiable.
So in light of that, you're saying it's still okay to go and bet?
It's okay to go, and plus these are the companies which are actually delivering returns. These are the companies actually which are doing well. So there is no, I don't think there is any problem in you saying that there is anything wrong being in these companies. The only thing is, at some point of time, even there is a value of a Taj Mahal also. At some point of time, these will become really overvalued, and that is the time when we'll have to be very prudent. So someone like me, I'm not looking at that basket. I've reconciled that, okay, it's not there in my portfolio, some of those companies, I can live with it. So I'm more looking at this mid bracket.
Basically diamonds in the rough instead of polished diamonds.
Exactly.
Right. So, if that is the case, then this underperformance in mid-caps I've seen in the last 2 years versus the large cap index, do you see that reversing anytime soon?
I am not actually talking about any index or industry. So there's no point, it's futile to talk about indexes, because we don't buy anywhere. I'm not buying mid-cap index.
It's the individual businesses.
I'm very confident that I can identify 15, 20, 25 companies out of that bracket which will hopefully sail through these difficult times, and when the good times come, there will a lot of market participants will participate in those companies. So this is where all your skill of identifying the right promoter, the right valuation, the right industry, the right blend of everything, that comes. And I am telling you, there are those opportunities which are available in the markets today.
What's more important to you, earnings visibility or a tactical approach based on valuation mismatches?
So I typically look at the perception gap. So like wherever we see that the reality is far better than what the market is perceiving, that is then we start to really look at those companies, and vice versa. Sometimes it happens that reality is this and market is hoping that this is what has happened. So I'm just saying, so that is the first place when we start from, and then we look at all the plethora of things, whether the upper size of the opportunity is big enough in that sector, whether the management is committed, whether they have the hunger, whether they can really scale through into this environment. Plus, then you look at the valuation. You also look at, now these days governance has become very important. So whether if the company is able to deliver the EPS, whether they will get the P multiple or not.
But will that also be a function of the sector that the company operates in? Like, for example, real estate. The entire sector is a part of the mid-cap index. Few bigger players have the edge right now versus some of the smaller players. So given to them, metals as a space is witnessing a cyclical slowdown. So no matter which company you pick out from that space, it is in a cyclical slowdown.
There is a headwind, but I'm saying, given, like you said, real estate sector, given what changes have happened, RERA, plus it used to be 8% of the overall market cap. In 2008, it is not even 0.5% of the overall market cap. So at some point of time, it's a large sector. So few companies will do well, and this is my point, that I see at least 70-80% people who were large developer in the real estate sector 10 years back, or even non-existent today because of the problems which have happened, liquidity squeeze, the fall in real estate prices, the leverage at the promoter level, the leverage at the company level. So now the players who are left out, they will do really well.
Do you feel that,
And market will recognize it at some point of time. The real estate sector cannot be 0.25% of the overall market capitalization.
And the complete...
But it is tough. When it is going to improve, we don't know. But we know for sure that the few companies which have actually done a good job in the last 10 years, they will do well.
Okay, so if you were to not go again to specific stocks, but narrow it down to sectoral opportunities, that obviously there is an opportunity in real estate. Commercial real estate particularly is superseding residential real estate. But, affordable homes, and I'm just throwing names, Prestige Estates, for example, is doing relatively well compared to an Oberoi Realty. Any other sector where you feel that the opportunity and the ecosystem is supportive of companies to grow?
So, Devina, I'm not trying to bug the question, but what I'm saying you is, it is basically bottom up. So there are those opportunities which are there in PSU basket. Some of the infra companies have got beaten down so badly that they are available very, very attractively. But that doesn't mean that you will go and buy the infra sector. That doesn't mean that you will go and buy the pharma sector. So I think there is a bottom-up opportunity where you can clearly see that these companies have done a great job. The promoters are more or less stable. They don't have a huge leverage. The companies are not leveraged. But because of this overall massacre which has happened in mid-cap and small cap space, even those companies are available at a very attractive valuation. So you will find that those companies in a PSU basket, for instance, like we were just discussing, if supposing one strategic disinvestment happens and if the government is able to go through, then you have so many companies which are trading at 6, 7, 8% dividend yield. I don't think after that is done, it will continue to be continued. So you will find those in banks. You will find those in NBFCs, which is, you will find them in real estate, you will find them in pharma, you will find them in PSU basket. So I think
NBFCs become totally polarized though, just the handful of 6 or 7 NBFCs, gold financiers, for example, your Bajaj Finances of the world. This is where much of the market cap erosion that the rest of the NBFCs in has been added in.
Exactly. So, but you will see that over the next 1 year, it will become clear that some of them which are being perceived today that they will not survive. Some of them will survive and eventually they will create value. And again, you don't need to be adventurous. All I am saying you is this is not the time to be adventurous, because if you're wrong, you may end up losing your entire capital.
Okay.
So you don't have to be. You have to make sure, and you have to watch the overall environment, how things are improving. How this whole stress will also be taken out gradually. So you have to be doing your homework with double or triple the passion and the effort which you are used to in the past, because there is no real margin for error. I would say it in Hindi, nazar hati ki durghatna ghati. You basically, if you just take your eyes off and little bit,
I need to be on the ball.
And there is absolutely on the ball.
So bear market survivors, that's the tagline that I take away. Look out for those kind of stocks. Thanks so much, Madhu, for joining us.